Welcome to the Pump and Dump channel. Today I want to talk about interest rates and mortgages in the Eurozone and give a little bit of taste of an argument I had with my wife today about the mortgage we took out on the house in mid 2016. So as you can see here, this is an extract from statistics about mortgages in my country. So they talk about here the variable rates being at 149 and fixed rates at 164 as of June 2019, and my wife being in the banking sector told me that today interest rates were around 1%, which is September obviously. So she's telling me now that back in 2016 when we signed the mortgage agreement, she was right that we should go on a variable interest rate and I was wrong. And the bank lady, of course, she was also saying we should go onto the variable rate because there was the common perception that they did not see interest rates going higher in the foreseeable future. So to demonstrate the point in time when this happened, I will take here the German 10-year bond as a proxy. It was something I looked at back when I decided I wanted to go on a fixed rate mortgage. So as you can see here, this is the point in time when we signed the mortgage. You can see here the interest rates on the German 10-year bond were around zero. I could not conceive of them going lower. I mean, I thought that they might go negative for a very short period of time. And of course, like talking like about the past, I cannot prove that I said that, I know that, but it doesn't really matter. The point is, I thought that interest rates would rise because in 2015-16 the Federal Reserve announced that they were going to normalize rates, and they of course took rates from a quarter basis point to a quarter percentage point to 3.25% in 2018, and then globally interest rates started collapsing again, including the US 10-year bond. We can see here it's currently at 146, and in June the Federal Reserve, they did a quarter basis point cut, and now we are kept going lower and lower, and interest rates on 10-year German bond are a negative 70 basis points. So of course in 2016 I did not have the privilege of knowing all of this. I was at this point in time, I said to myself, interest rates should start rising because of what the Federal Reserve is doing, and my belief of course was that globally other central banks would follow suit because they also lowered interest rates, and therefore I thought, well, they lowered interest rates back in 2008 when the crisis was happening, and I thought they would also raise interest rates as we come out of this financial crisis that was in 2007 to 2009. So, yep, at this point in time, I said fixed rate, and my wife said we should do a variable rate, and I explained to her the inverse relationship between house prices and interest rates, and I also explained to her the risks of going on a variable interest rate versus a long-term fixed rate. And what I basically said was that in the case the interest rates go down, we would have a higher house price, and if interest rates went up, we would have lower house prices. And in that scenario where interest rates went down, we'd of course have the benefit of a higher valued asset, and we would be saving money on the monthly payments. But if interest rates went up, the house would be worth less and we would be paying more for it. And I explained to her that the risk was that we would be in a situation, because at this point in time when we're signing it, we were basically signing off 30% or so of our monthly income to service the mortgage. And given that we had to buy a mortgage because house prices here are very high and have gone higher actually, but the point is, I explained to her that if interest rates rose with a very high mortgage, we would be in a situation where we'd go from this 30% to 40, 50, 60% of our monthly income. If we normalize the 3% or 4%, we could get to a situation where we'd be 80% or even above 100% of our monthly income to service the mortgage. And I told her that was extremely risky, and I don't want to be in that situation where we get to 80% of our income going going into paying the house and eating Campbell's soup and beans to survive. I just told her that this was not, a situation I wanted to get to and have to then face that decision of whether to lock in, long-term poverty and not lose the assets, or whether, let it ride and hope that interest rates go back down and risk that interest rates keep going up, and then get to the situation where we can no longer service the mortgage and have to sell the house in a down market. Because like I said, if interest rates go up, the house price goes down, and that kind of leverage, that's something I wanted to avoid at all costs. So basically what I said was, if we're going to fixed rate, if interest rates go down, if they go down, the house price would go up, and our monthly payment would still be the same. So we wouldn't have like the benefit of the cash flow increasing, but in financial terms, the house would be worth more, so our asset would increase versus our liability staying the same. But if interest rate went down, we would be in a down market, and with the fixed rate and the fixed payment, we would be in a situation where, if there were other people who absolutely had to sell, causing prices to not just go down but plummet, we would be in a privileged situation where we would not have to sell, and we could maybe even pick up another property. So that was kind of basically the argument I came up with, that taking a fixed rate mortgage is the way to go along the housing market and be hedged, or at least in the sense that you have two opposing forces where one's value goes up whilst the other's goes down, and vice versa, and that kind of like balances it out better, because on a variable interest rate, you are really hoping that they go down, and if they do go down, you make a bunch of money and save a bunch of money. If they go up, you get screwed. So the variable rate is like full risk on, and the fixed rate is the more conservative hedged position. And as you can see here, in the short term, interest rates went lower because of some noise around Brexit. I remember that correctly. I was hoping to get seeing if I could get a better rate, but we'd already signed, so we signed at 185, and I could have got at the absolute low something like 156 on the fixed rate mortgage, and yeah, that's kind of how it went. The Brexit noise passed and interest rates started rising again. And during this period of time, of course, notably from 2016 to early 2019, I had been proven right, and we saved a lot of money, and my wife, she was quiet. But now, because of this here, now she's trying to tell me that we should have been on a variable interest rate all along, even given, as I just explained, that during this period of time would have been paying more. And there's some people I worked with, they bought an apartment in 2017 or 18, and they told me that they signed a fixed interest rate of 2.1 or 2.2%. So essentially, we're at this situation now here. 2016, it was here where we had to make the decision. I did not have the privilege of knowing 2019. And also, of course, we did not have the privilege of knowing 2017 and 18, because, as I said, during this period of time I was proven to be right and my wife was proven to be wrong. And as you can see here, we have this sharp decline, which looks like an Elliott wave. Bond prices are just going parabolic, and this is something that that I think is quite normal at the end of a cycle. The people owning these bonds, they kind of have to push them up in price to create this idea that this is a rally that you want to participate in, and you want to get in because the gains are going to be huge. But the people who load up and hold on to these bonds long term, as you can see with this negative interest rate, they're essentially paying more than they're going to get back in the end, and they're just hoping that they can manage to sell someone else at a higher price. And that kind of is the essence of trading or gambling. and that's kind of something I did not want to be exposed to. So yeah, you guys can tell me what you think. Was I right signing a fixed rate here in 2016, or was I wrong given the information I was privy to at that point in time? I've made my case that I still think, even though we have interest rates down here, I still think I was right, and I will be proven to be right in the long term. And yeah, that's basically all I have to say. Leave a comment to tell me whether you agree or disagree, and you can subscribe to get notified whenever I put out another video. So have a good day.